everybody, it's Amy here from Consulting Private Wealth. Just going to do a video this week on FOMO investing. It's an investment style really brought to light by social media. You see the headlines, 20-year-old worth $4.5 million after buying $1,000 in Bitcoin, or man who bought Tesla at $7.50 is now retiring at 39 years old with $12 million. So you read these headlines on social media and you have a reaction instantly. It's either you're level-headed and you're logical and you think, wow, those outlier situations are great for that person, but I'm on track with my finances. Or you're fully freaked out and you're trying to gather all your funds to put them into the share trading platform as quick as you can. You're in a frantic state, switching up your investment strategy and trying to copycat whatever article it is that you've just read. So that is FOMO. The fear of missing out. It affects every aspect of our lives if we let it. Social media, like I said, is a huge contributor to that fear. And because we see it every day, we see as little as situations where people are on holidays and we think, oh, am I not living my life to its fullest? I feel like I'm missing out. I'm going to book a holiday next weekend, even though my finances probably can't fully support that right now. Especially with investing, the hype makes us feel like it's okay for us to overlook our due diligence, and it puts a sense of urgency on us, placing a trade in whatever stock, because we don't want to be that person that says, wow, I should have gotten into Tesla 3 years ago and maybe I could be retiring or living a luxurious life by now. But that's that hindsight bias, and that is extremely unhealthy for us to hold on to and always be thinking, what if? On the other end of the spectrum, there's the fact that you can actually lose money by partaking in FOMO investing. The pandemic is a great example of this. We all saw headlines, businesses to shut doors to consumers. Everybody started selling. And people seeing all these sales being taken place, they think, oh, they know something I don't know. This is much worse than it looks like. I'm going to sell out. And if you're one of those people that sold when the market was at its worst during COVID, and then it spikes back up, you've lost all of that gain by selling out, when by now we're fully recovered, you could have regained all of that. And just the psychological stress that would take place in that, you need to know exactly when to buy and exactly when to sell, otherwise you can be one of those FOMO losers. Another reason FOMO investing is extremely unhealthy is that you're not setting up good investing habits. It's harder to unlearn the bad habits than it is to learn good habits. A great idea with investing is to set up a few check boxes, things to consider when you're looking at a business. Otherwise you're pretty much gamifying businesses. These are real life businesses, people work in them and they have strategies in place to grow. And we're turning that into a bet with no consideration, and that's not always going to go in our favour. It just shows that you're not taking your finances seriously if you're willing to just follow the crowd. There are a few coping mechanisms that I believe can be adopted to combat FOMO investing. One is reflection. You're reading these headlines all the time. It's super important to just take a second and think, how is this making me feel? And why am I feeling this way? It might be because you have financial stress in some other aspect of your life, or insecurities about where you are in life at the moment. Just taking that time to reflect is also going to give us time to become more level-headed about the headline we've just read. Another mechanism you can use against FOMO investing is research. Do your due diligence. Google the business, check their performance, have a read of a few different articles. Don't just read that one headline and dive in. Another strategy would just be to plan your money. This is a basic strategy that's been around for a long time. You can set aside some money for debt, some money for savings, and some money for investing. A good plan with a powerful reason why behind it is going to make you much less likely to jump around with your money and more likely to trust your plan and trust the direction that you're heading in. I think that's a pretty good place to wrap it up for this week. So thank you for watching and see you next time.